Hi there, I'm Paul Bagnall. Welcome to Market Call. Jaime Carrasco is on the show today. He's a portfolio manager at Canaccord Genuity. He'll take your calls, emails, and tweets on precious metals and North American dividend stocks. You can call us, and please do, at 1-855-326-6266. You can also send your question in by email to marketcall@bnnbloomberg.ca. Let's go to gold. Jaime Carrasco will have plenty to say about this asset when we get to him before too long. $16.50 very nearly is the price of gold. That's June traded gold in New York. Trading down today, but the path of travel has been up lately. Let's go to crude oil. That's not the case in the case of true crude oil. There is a very weak West Texas Intermediate crude price of $21.31, down 5.7% today. The news is worse on the Canadian side of the border, where Western Canadian Select is trading at just over $5 per barrel. Well, we're joined now by Jaime Carrasco of Canaccord Genuity. Thank you very much for joining us. I know you've got lots to say on gold. What are your thoughts on gold's movement, and how much gold do you think investors, Jaime, should have in their portfolios right now?
Two good questions. Thank you for having me back, and may we live in interesting times, so they say. First of all, as an asset allocation, which is the right question, I've just recently raised my minimum gold holding to 30% from the 25% that we had it at. That was the week that the prices fell out of bed, and we reloaded, increased our allocation. Now, from an asset allocation perspective, if you follow the last time I was on, I was already at 30% cash, and we raised cash again when the volatility started. But as far as the precious metals, we're definitely holding and increasing that allocation, because it's important to point out that gold itself is doing what it has done for 4,000 years, which is rise right along with systemic risk. As risk has been increasing, the price of gold has been increasing. By extension, I would like to point out that the earnings of the companies that I own, the producers, have been increasing, even though their share price has not. Now, this is a great opportunity for those that are not at 30%, because I think that everybody right now, the majority of Canadian and North American investors, are at almost zero allocation in gold. And it's a pretty good time to start adding. Now, I sent over a couple of charts that I hope we will be able to show them.
Yeah, we're showing one right now. It's how gold is performing versus the Dow. So what we've got on our screen right now, Jaime, is gold, the Dow, and what have we got there in white?
And
control?
the HUI,
right.
the HUI, the Precious Metals Index.
Correct.
Now, first of all, it's important to point out that this chart goes back to the beginning of October 2018, when the Fed was still rising rates, but then they lost control of them, and we have the big decline into January of 2019, and that's when they start lowering rates. To me, that was the inflection point, because we have to understand that we have a number of storms here. The COVID-19 issue is a healthcare emergency, global emergency. Never thought we were going to see this, but prior to that, we were already entering a financial mess, because as being shown by what was happening in the repo market and the fact that the Fed was already starting to print money, right? So to me, this is important, because back to October 2018, gold was already outperforming the Dow, and it was already starting to behave as a safe haven asset. Now, when the market fell out of bed at the beginning of February, the gold stocks followed down, but gold never broke down, which is important because the earnings of the companies are backed by gold. Gold in Canadian dollar right now is hovering around 3,000, just below 3,000 to 22.80 as we speak. And the companies are producing, like if you look at Agnico Eagle, which is always my go-to, they're producing at about 600 Canadian. So their earnings are there. Kirkland Lake, just over the last 3 weeks, has bought more than 10 million of its own shares with actual cash flow. So to me, this is great, because they are doing what they've done for 4,000 years, which is increase as systemic risk is rising. And that is the benefit that I've always said, that these are the best assets for uncertain times, and they're proven correct, even though the share price isn't there yet. And I think it's a benefit to be acquiring these. For the overall market, well, the big issue to me is the debt that we have in the system, right? The real tragedy is that central banks have spent all of the money trying to maintain this system going, but now we have a massively big debt system that requires cash flow. And what we have now is the ultimate black swan, because cash flow is shutting down globally. Student debt in the U.S., oil debt because of oil prices. You have mortgages are shutting down. How long can a debt-based system last without cash flow? That's the key issue. Look, central banks, we're up to the Fed is up to $5 trillion now. That completely reversed overnight. The Bank of Canada, we're all increasing deficits, but it's to maintain a debt system going. How long will it last? We don't know how long this shutdown is going to continue. Because of that, I would rather stay cautious and watch and see what happens in terms of the global slowdown as this problem still filtering through society and we still shut down. I never thought we were going to be doing what we're doing on a global basis right now.
What are your thoughts on investors getting exposure to gold through futures traded gold or through shares of gold mining companies? Where's the greatest value right now?
Well, I would not trust anything with futures driven, right? Any of the ETFs. Look at what was happening the week that the stocks fell out of bed. Anybody that owned the GDXJ or any of the futures-backed ETFs, you were selling your shares at a 20% discount to NAV. That's crazy because what you own is a piece of paper. Now, there is massive problems right now with the paper versus physical market. You can't pick up any gold for under 1,800 US globally right now because we have another shutdown, and that's what's happening to physical gold and physical silver. We don't have any. The Canada Mint is not producing any. The U.S. Mint isn't producing any. So we have a disconnect between the physical and paper market. The real problem is that somebody for the last couple of years has been selling more paper contracts than they could ever deliver. And now we have an ultimate black swan because we have a shutdown in production. So if you own a piece of paper backed by gold that isn't there, you have a problem. I think it was ABM AMRO that just this past week that told everybody that held any of their gold certificates that they were going to cash them out, and they don't have the gold that they were supposed to be backed by. Well, that is the case with all of those derivatives-driven products. So I would not touch them. I think the ultimate would be an ETF that's actually backed by segregated physical or the producers, because I still believe that the reserves that they hold on the ground are going to be worth a lot of money when the paper market stops functioning, because it will. If they can't deliver the physical at the time that everybody's scrambling for it, there is a problem, and we're going to have force majeure, which has happened in the past but rarely happens in terms of the exchanges not being able to deliver. Now, there's been a couple of changes within the delivery mechanism between the LBMA and the COMEX just over the past week, so we're starting to see those stresses within the system. They raise margin as well, which means that anybody that had those contracts had to sell right now to cover. But I think that accounts for some of the decline in the price of gold. But again, if you don't own physical, you don't own anything. So that's my approach to it.
Any thoughts on silver?
Love silver. Silver, if you really think about it, when the price of gold and pegs and finds its true value, people will not be able to afford gold. That'll be affordable to the very wealthy. And silver at right now, I believe $24 is what you can pick up the physical at, is going to have a much greater upside on the on when price discovery really takes place, and the silver producers as well, by the way.
What about other metals in the precious metals complex, palladium, platinum, etc.?
Well, platinum, palladium, if you wanted to play that, one of the, I believe it's the BGM group, has a really good physical ETF with stored physical silver, gold, and platinum. It's very hard to play the platinums and palladium. I used to own North American Palladium, but I was taken out of that, and now I'm looking for another palladium play. But right now, I don't want to make any changes. I think right now we hold on to what we have, and I would rather add positions to new clients coming in. Again, on that side, I manage two funds. One is a strictly precious metals fund, and the other one is my equity income portfolio, which is at 30% in producers and royalty companies.
What are your plans for your cash? You say you're at 30% plus in cash. Over what period of time are you looking to deploy that cash?
Well, again, I think it's important to understand that while the COVID-19 is still spreading, the global economy will continue slowing down. So I would want to see at least a level off of of that in Europe. The U.S. is just getting going. There was a great chart that I posted on LinkedIn that really lays out where the U.S. versus certain countries are against China, which is much further ahead in terms of the spreading and control of the sickness. So I would want to get through that bell curve first before I do anything in terms of seeing where the global economy takes us. Now, how long can we stay in this situation where we have this overall funding into the debt system? You know, they were throwing, what, $1 trillion into the repo market just like about 2 weeks ago, and that continues to accelerate. So how much money is it going to take to keep it going, to keep the system going? I've always said that this is about debts. You got to stop solving a debt problem with more debt, and that's all we have. So I would rather wait much longer before I do anything and see as things level off.
That's Jaime Carrasco. He's a portfolio manager at Canaccord Genuity. He's our guest on Market Call today, and he will answer your questions on precious metals and North American dividend stocks. Please give us a call at 1-855-326-6266 when we come back directly to your questions. Welcome back. We're back with Jaime Carrasco of Canaccord Genuity. He's going to take your questions starting right now. We'll go to the email inbox. Derek is our viewer. His subject line is Interpipeline, IPL on the TSX. What's happening, he asked, to Interpipeline?
Well, good question. I think what's happening with all of the pipelines, by the way, I love the pipelines. I think they're great, great assets to own for cash flow. But right now, the bigger issue is that we're having a big sell-off of the market overall. And when markets sell off and fund managers need to sell because they're getting redemption, they're going to sell the most liquid assets first. That's why when it comes to the pipelines, I have cut them down to pipelines, utilities, REITs, all of those sectors within the income producers. I've cut them down to the bare minimum that I want to hold on to, and I'm going to wait. When you have this kind of liquidity crisis that everybody's selling, everything gets sold. So eventually I will be adding them. I'll watch the yields go up. But for now, I think it's more important to stay cautious and wait before we jump in. So I don't have any problems with Interpipeline. I think it's a great company. We have it as a buy with a $15 target, but I would rather wait, let the yields increase before I jump in.
Do you think the dividends are safe on these pipeline companies, this one in particular?
Yes, definitely. You know, what I would look at is AltaGas. AltaGas has suffered through the worst of the Calgary economy. They are a pipeline type of company in that they offer supply, storage, and distribution of energy throughout Alberta. And throughout this whole period, they have held on to their value because no matter what, you have a bare minimum level of economic activity. To me, that's the important part in that they continue to deliver cash flow, and I see it as getting paid to wait. I think with the pipelines, it's the same thing. We're going to see the energy pipelines being used throughout. There might be some cost pressures, but again, I'd rather wait in cash and be buying them later. Okay,
let's go to our second email. BB is our viewer. The subject is, Vermilion, ticker symbol VET on the TSX. Bibi writes, I bought 65 shares of Vermilion earlier this month. I'm not sure what to do with it. Do you think this company will go bankrupt? Should I just hang on to the stock? I'm a novice. I only started investing.
Of all the oil companies, this is one that I definitely don't think they will go bankrupt, so I wouldn't be concerned about that. Bottom line, they sell energy in Europe, and the good thing about that is that they're getting a higher level of a higher price. I would be more concerned in terms of bankruptcy of all the fracking companies in the U.S. that can't function at whatever oil prices are at now, $30, I believe. Hold on a second.
WTI is way down in the low 20s.
21, 29. So we are looking at very, very low prices, and only the ones that are the most capitalized are going to do well. I think Vermilion is one of those. But on the fracking side, those guys are in trouble. Now, do the connection from fracking to all the debt that is owned by that whole sector, right? How long can that sector last without having any debt issues to the banking sector that has given them those loans last, right? Without having some kind of a systemic risk. Again, people should focus on debt more than anything. When it comes to Vermilion, you know, the bare minimum energy is being sold in Europe where they work. They have a good pricing. We still have them. We have ranked them as a whole right now. We have them with a $6 target. the capital expenditures and output, I think they're going to be okay. I wouldn't be concerned about that. But again, I have them at a minimum holding right now and waiting to get in. I like the dividend. I'm glad they cut it. That's the real question: is which of these companies are going to have to cut dividend? I think a lot of them will. And so to have high cash levels for later, I think it's a better entry point when we know how long before the global economy starts to pick up.
Okay, let's go to the phone lines for the first time in this program. Gary is our first caller. He's in Toronto. Hi, Gary.
Good morning, guys. I hope both you and your families are doing well.
Thank you.
Thank you, Gary.
Jaime, this question is about MetaPharm Labs. I'm wondering if you can give an update on it. I know they launched a CBD product yesterday. The market's didn't like it. They went it down. And if you have a price target 1 year, I'd appreciate it. All right, thanks.
Well, we have it as a 675. We still have it as as a speculative buy as of March 26. You know, it's funny because I think with the whole cannabis industry, I think this is one of the best things that could have happened to it. And the reason being is that sales are tracking. I follow a couple of the CEOs on Twitter, and they are reporting that sales continue to track along. And so this might be a really good thing for the industry. One of the issues for the medical industry on the CBD side is the fact that we are going to have some supply constraints with regards to drug production, especially the opiates, in that that 10% of an opiate drug that is produced in North America, the patent content that's produced here, but the bulk of the pills is produced in China. We're not getting any. So when it comes to the CBD side, everything is being produced in North America, and the sales are going forth. Also, they are creating jobs in that sector. So I think it's very good for the industry, and the industry as a whole has been consolidating for a couple of months now. And so right now I was looking at where to start picking some entry points. I'm going to wait, but I like what is happening. So I'm much more optimistic about this industry than a lot of other industries.
Thanks for the call, Gary. Let's take a break before watching. Ken is in Canmore, Alberta. Ken, how's it going? And thanks for calling. And what's your question for Jaime?
Well, I like Jaime's metaphor about resetting the sails in heavy weather, and I'm just wondering if he's got any crew that's willing to do that right now. Anyway, I wanted to talk about blockchain.
Yes.
And as a small investor, I'm looking at ways of participating in that sector, and I'm thinking maybe some ETFs are a good way to go. But I wondered about participation in blockchain now, and either on the NASDAQ or on the TSX, what investors may be able to do.
Okay, I love blockchain. I have about a 7% weighting in the special opportunities portfolio, and I have it through Hive. Hive, to me, is the freshest, cleanest way of participating in blockchain because they are the biggest listed miner of blockchain, of coins themselves. The beauty of the technology is that as it gets implemented, the true usage is also going to be reflected in the value of the coins as they grow and they continue to be used. From a user perspective, I see the blockchain today no different than the internet when just professors were using it for themselves. So global integration is just getting going. We just crossed $1 billion worth of Ethereum platform. The other thing with the whole blockchain technology, think about it of how it's going to change the world in which we live in. Look at the problem with the gold market right now with regards to the paper market. If we could set up a blockchain coin to actually block every reserve proven in the ground of each company and then track it all the way along, so we don't need the COMEX, we don't need the LBMA, completely begins to decentralize the system. That's the beauty of of blockchain, is that to me it's currency versus money. So it decentralizes everything, and that is important because it takes away the control of the system from a few players that are making all the decisions for us without really thinking too much about it, because all they have is an on and off they're not QE. So blockchain, I think going forward, is going to continue to grow, and this type of situation is going to assist it to even develop faster. So to make that question short, high would be the way that I would be playing it.
Okay. Thanks for the question, Ken in Canmore, Alberta. Let's go back to Toronto now. John's on the line. Hi, John.
Yeah. Hi, Paul. Hi, Jaime. Just for a bit of humor, it's incredible that the most precious commodity right now is not gold or silver or water or lithium. It's toilet paper.
There you go.
I saw the Marathon Gold story on Andy Bell's commodity show a couple of months ago, and it got my attention, Jaime. They have a well-respected manager who operated diamond mines in Canada's north. The deposit is close to 3 million ounces, and I believe it will be open pit. And best of all, it's in eastern Canada, Labrador, Newfoundland. I love your energy, Jaime, and I appreciate your help. Thanks again.
You're welcome. Marathon Gold. I do not own it in my portfolio. I have looked at it. I'm at the stage where there's a lot of really good companies, but I have to stay disciplined. We have it as a speculative buy with a 250 target. It is a good deposit. The assets continue to grow on the ground, which is important. Let's back up a bit and look at how I go about picking companies for the portfolio. I think if you're getting going in this sector, the most important thing to start building a portfolio would be within one or two good of the royalty companies, because those are the least risky ones, followed by good quality producers. I tend to stay away from the Barricks and the Goldcorp and the Kinrosses, because to me they're like IBM versus Microsoft circa 1995, which is why I go for the Agnicos and the First Majestic, and the ones that are going to have the better earnings leverage going forward. Also, lower cost of production. If you look at Agnico, they're one of the lowest ones. Followed then by the smaller up-and-coming companies like Marathon. That's where they would fall. So it'll be 3 levels down in terms of building a portfolio in these companies. And then some good quality explorers, if you can put them within the portfolio. Marathon, like you said, the deposit seems to be quite attractive. Good grams on the ground and good width, and it continues to grow. So, and it is in Newfoundland. I happen to love the people from the Rock.
Thanks to John for his question on Marathon Gold. Thanks to all our other questioners as well. Lots more coming on Market Call today. Stay tuned. Past picks are coming up next. We're back with Jaime Carrasco of Canaccord Genuity. This is the segment of the program where we take a look back at some of Jaime's earlier top picks. Pick number 1, North American Palladium, ticker symbol PDL on the TSX. We talked briefly at the top of the show, Jaime, about the other precious metals, platinum and palladium. Here's a miner that does just that.
Well, with that one, we get taken out, so I don't have it anymore.
Right, so there it is. Tell us the backstory here. This is a takeover. It's been bought. You can see the flatline share price
yes,
at 1973. So what, it's being taken out at about 20, is it?
That's right. It was bought out by an Australian company. They've taken it over, and we got paid out cash. So that was last fall. Now I'm looking for another palladium play, but haven't come across one, and I don't really want to make too many changes in the portfolio at this point.
Okay, let's move on to Kirkland Lake Gold. That's pick number 2, past pick number 2. KL on the TSX, a familiar name to most gold investors. It was recommended on March the 15th of 2019. It was recommended at the price of $44.59. It's trading essentially at that now, $44.08 is the price we see on our screen. That's a return of minus 1%. There you see a live look at the stock. It's trading at $44.15 at this moment.
This is a company that we were taking profits all the way up. Again, I work in an asset allocation model, so with Kirkland Lake, we always had it at 7%. And on the way up from 2015, we got into the stock at about $5, I believe, around 2014. And on the way up, as it continued to outperform, we kept cutting them back. So every quarter, we cut back the positions, and we used the profits from it to buy other companies. They have recently merged with Detour Gold. Now, they have shut down the Detour mine for now because of the COVID-19 situation. But we have it as a buy with a $53 target. I think that the merger between Detour and Kirkland Lake have created an amazing company with really good prospects going forward, low cost of production, and a very streamlined production in that one was a short mine life, high grade, the other one was longer mine life, lower grade. Now we have the combination of the two, and I think going forward it'll be great leverage. So I continue to hold this within the portfolio.
Okay, next one is Valens Growworks, ticker symbol VLNS on the TSX Venture Exchange. We'll bring up the screen on that one. That was recommended, I believe, last March as well. What can you tell us about Valens Growworks? Recommended at $3.03, trading now at $2.29. That's a negative return of 24%.
I still hold it within the portfolio. It's a much lower amount than I had originally. Took a lot of money out, above $4 out of this company. I'm still holding it. I'm waiting to get back into the sector. Like I said earlier when we were talking about MediPharm, I think the sector is when I would want to be looking to add these stocks. I've reduced positions in them for quite a while, but I like what's happening. I like how the sector is consolidating. It went through a massive first boom. Now it's reorganizing itself. It's becoming more global. Valens is one of the companies that we have. I think it's hold on a second. Valens. $8 target, if I'm correct. Yes, $8.25. We like it. They just changed over to they're producing a beverage with CBD and THC, and it's a great company.
Okay, Valens is a medical marijuana company. We'll be back with Jaime Carrasco. He's a portfolio manager at Canaccord Genuity, answering your questions on precious metals and North American dividend stocks. Give us a call at 1-855-326-6266. Welcome back to Market Call. Let's get back to your questions. Let's go to Montreal, where Pierre is standing by. Hi, Pierre.
Hi. How's it going, you guys?
Good.
Okay, I'm looking to buy Suncor. Don't know if it's good, but it has a high yield. Or should I go in the pipelines like IPL, what you were talking about earlier?
Jaime, Suncor Energy, been extremely volatile this week. It has been up big. It has been punished today. The caller, Pierre in Montreal, wondering if this is the time to buy Suncor, or should he be looking to pipelines?
Pipelines would be the safest, but Suncor, with the pullback they've just had, it represents a pretty good entry point. Suncor is the go-to company when it comes to oil companies in Canada. They're big. They produce at lower cost than anybody else. We have it with a $40 target. We have a buy rating, and that's as of March 24th, so that's a very recent update. I think at this price, if you're looking to add energy, wouldn't be a bad entry point. Again, I would be waiting to see, though. I wouldn't do anything until at least another couple of weeks to see what is going to be the full impact of the virus. But that would be a really good entry point if you wanted to add something with a good yield. Will they cut back the yield? That's the question to be asked with all of the dividend-paying companies like Suncor. But as an entry point, I think if you're looking to buy, choose half of the dollar amount that you want to put in as an entry, and then wait. But we still like it, and I think it's one of the most solid of the oil companies in Canada.
Okay, there you go. Good question from Pierre in Montreal. Let's go to Kate now. Kate is in Toronto. Hi, Kate.
Hi. Thanks very much, gentlemen, for taking the call. If I may quickly, Paul Bagnall, thank you for the excellent work you do in whatever capacity of show they put you on. Very much appreciated.
Thanks so much.
And Jaime Carrasco, always of interest when you're on the show. Thank you.
Thank you very much.
My question is about taking some positions in gold stocks, more for a trade, and then eventually, but unless I missed it, I didn't hear what you think gold could fluctuate to on the upside, on the downside. So it's two parts. One for trades now, and one for hold for, I guess we could be looking at, 2-3 years in the future for this gold strength, if you will. Thank you very much. I am looking forward to what you can tell me, what I can write down, and take positions in sometime soon or later, whatever you suggest. Thanks again.
Okay.
That's a great question. I don't know if we can put up the other chart I had sent over, because that gives a pretty good relative value between gold and the HUI all the way back to 2011.
Yeah, so just which chart are you looking for in particular, Jaime?
There were two charts that I had sent over. The other one was just the HUI versus gold all the way back to 2011, because
Okay.
it gives us a really good picture of the relative value of the companies right now and how cheaply they're trading. If you look at the HUI, it's currently trading at just around 200, to 198 as we speak, and gold sitting at 1654. Well, last time gold was at 1500, the HUI, the sector index, was trading at about $450. So there's a massive discrepancy of where the companies are currently trading. In essence, the companies are trading as though gold's sitting at about $1,000 right now. Now, that is the benefit. The benefit is that the earnings of the companies are actually tracking higher, but by the same token, the company's stock share prices are followed down with the Dow. So to start building positions at this point makes a lot of sense. For somebody older, what I would recommend, start looking at Franco-Nevada. One of the rules with the gold companies, if you're going to jump into the gold trade, I would not be looking at ETFs. I would be looking, unless they actually own the shares, but then you have to do a little bit of homework. What I would do is build positions looking at, first of all, the Franco-Nevadas, the Agnico Eagles, the big quality companies. Within that, I would want to choose one royalty company, one big company, and one good solid gold producer and one good solid silver producer. If you have those three, so Franco-Nevada, Agnico Eagle, First Majestic for the silver, I think you're paying the three parts of this cycle on the way back up. Then you got to look at asset allocation. I recommend that at the very least you hold a 20%, right now we're at 30%, but start with a 20% allocation. So if you have $100,000, have $20,000 in the sector. If all of a sudden you're holding on to that and it becomes 15%, top it up to 5% again, right? So asset allocation takes away the decision-making between fear and greed. During the last 2 weeks, while the prices were getting killed because of margin calls or whatever reason they were coming down, it went below the allocation. So we just brought it back up to the allocation that we had. That way, I wasn't emotional about buying. It just made sense. Well, these are good quality companies with good earnings. Let's pick some more up, bring it up to the allocation, and we increase that allocation from 25 to 30%. That way, it becomes a process, not an emotional decision in terms of how to buy them.
Thanks very much to that batch of questions. We will take another break, but when we come back, his top picks coming up next. Our next question comes from Ron. Ron is in Grimsby, Ontario. Hi, Ron.
Hi there. Great show, guys. My question is on XGD, iShares Global Gold Index. I own some shares, and I would like your opinion. Is that a good one to hold or move on? Thanks. I will hang up and listen to your answer.
Okay, XGD.
I don't particularly like that ETF because I can't. I want to make sure that you own the shares. A lot of these ETFs are set up with derivatives, and you are getting quite a bit of a divergence between the NAV at a discount or at a big discount when the market falls off. So because of that, I don't want to be playing that variance. I'd rather have the companies themselves and have the full NAV within the portfolio. So, you require a little bit more homework in choosing the companies to be bought. But again, I would not want to buy the ETF. I'd rather have Franco-Nevada as my single holding, or a good solid blue chip, even Barrick, than the XGD.
So the XGD, we'll just tell viewers, is an ETF that includes shares of big mining companies, Newmont, Barrick, Franco-Nevada, Agnico Eagle, etc. You've said a couple times through the course of this program you don't like gold ETFs at this juncture, either ones that hold gold or ones that hold mining shares, correct? No,
if they hold the mining shares, I would buy them. And the one that I like, that I would recommend to anybody that did want an ETF, I would go with the Harvest Gold ETF, Gold Producers ETF. I can't remember the full name, but that's the one that I would recommend if I had to make one choice and I wanted a diversified pool, the Harvest one.
Okay, I'm going to look up the ticker symbol of that because Ron in Grimsby was asking about XGD as a vehicle. I'm going to get that. Ron, keep on watching, Ron. We're going to get you the ticker symbol of that ETF.
I'll look for it as well.
The Horizons
No, not Horizon. Horizon.
Horizons or Harvest?
It's Harvest. The Harvest Gold ETF. Gold producers.
I'm hearing it's HVG. Is that it?
That's the one.
HVG. So Harvey Victor Gordon, and there it is on our screen right now. A one-year performance. That looks like a pretty choppy trader, but HVG is the ticker symbol.
The whole sector is very choppy, so you just have to. Sorry, that's a stock.
Yeah, that's right.
It.
That's a corporate stock. That's not what we're looking for.
That's not the Harvest ETF, gold ETF. Hold on, I'll look it up while we move over to the next. I got it. It's the Harvest Global Gold Giant Index ETF, and the symbol is HGGG.
HGG.
G. Three Gs.
Three Gs. H triple G, Ron. Thanks for your question. And sorry it took so long there to get you that. But that's what Jaime recommends as an alternative to the ETF you asked about. There it is. H triple G on the TSX is the ticker symbol. That's what Jaime Carrasco recommends if you want exposure to gold mining companies in an ETF right now. Okay. We've only got 30 seconds left. Jeff in Ottawa is asking about, he's on the line right now. He wants to know about Agnico Gold. Jeff, put your question quickly to Jaime.
What about Agnico Gold shut down from the mines, and all gold mines shut down COVID and supply chain problems in Africa, so no earnings? Will the stock companies go down because they only make 75% of their gold? Thank you.
I am holding on to my Agnico with 37 million ounces on the ground. I have no concerns, low cost of production. I think a global shutdown of the mining sector would be the best thing that could happen. Also the shutdown of the refiners, because for once we have an opportunity to really ante up to the guys that have been selling paper contracts. How are they going to come up with all this gold that they promise that they don't have? So if you want to put a crimp on the paper market, this is the best thing that could happen. So to me, it's a blessing. And I think it's a massive opportunity for the producers and anybody that understands the benefit of physical gold versus paper gold and the game that has been playing on. Agnico at this point, we have it as a buy, and it's a great, great company. It continues to be the mainstay of my portfolio, and it has been since $22 back in 2012, I believe, 2014.
Okay, and that company, in combination with its partner Yamana Gold, took the decision recently to idle their big Malartic mine in northern Quebec. After this, we'll be back with with more top picks next. Welcome back. Here's another episode, or another segment rather, of top picks from Jaime Carrasco. Number one, Alamos Gold, ticker symbol AGI on the TSX. Jaime?
Well, this is a new addition to the portfolio, and it came about because I posted and sent out to clients an interview with Pierre Lassonde that happened 2 weekends ago, and he mentions two companies off the bat of that interview: America Silver, which has been one of my top picks all along, and Alamos, as examples of companies that are trading ridiculously cheap in relation to their earnings. When I looked at it, we have a $11.50 target. We have it as a buy, currently trading in the low fives. Oh, it's jumped back up now over this week. Look at volatility. Again, great producer, low cost, and it has quite a bit of potential going forward.
Okay, next one, Osisko Royalty, ticker symbol OR on the TSX. This is a gold royalty company?
This is a gold royalty company and comes about when Osisko sells out Malartic to Agnico. We have it with a $17 target. If anybody wants growing income again, royalty companies are not producers. They're more of a finance company that gets the royalty once the mines are up and running. Osisko's cash flow will continue to move forth, and it's a good royalty play as an addition to other royalties.
The big player in the royalty space, of course, is Franco-Nevada. You've mentioned that a couple of times. Why don't we just pause for a moment and give us your thoughts on Franco-Nevada right now?
That's been the mainstay. That to me is what I put in my parents' accounts right off the bat as my initial gold holding. If you look at the long-term chart, it kind of shows why. It's steady cash flow. It's not just gold, silver, oil, copper, so it's more diversified. But it's a great company with a $1.43 target, $1.43, dividend. Yes, $1.43 or about a 1% dividend. All of the royalty companies, I think, if as gold prices continue to move and earnings continue to grow, their dividends will also be paid out to shareholders, which is why I like them.
So that stock, until the big volatility recently, was trading at, I believe, an all-time high, certainly a multi-year high. It's now off that high. Would you be a buyer of this stock at these levels? Most
definitely. If anybody doesn't have a position in this sector and is looking to get in, build a 5 to 10% position, that would be on the core part of companies to buy. Again, by working with asset allocation and saying, okay, I'm going to take a 5% stand and hold it there, you're taking away the emotion of buying at this level and buying into the volatility. And I think that's important, to use a process that gives you discipline in times like this.
Okay, let's get now to your third and final top pick, Fortuna Silver, FVY.
Yes, I wanted to have a silver pick because I do like silver. One of the concerns I have is everything that's starting to happen in Mexico, where 80% of silver production happens. What I like of Fortuna Silver, they have a mine in Argentina that's about ready to go online. And when that comes in, cash flow is just going to kick in. And so because of that, it's one that I would be buying at this level. They do produce in Mexico as well, so it is a producing mine. We have it with a 650 target, currently trading at 305 when the report was done. Hold on, first, what's it at now? Fortuna at 343. So it is a good entry point at this level. And I think once that mine comes online, cash flow will just explode on this company.
Jaime Carrasco, thank you so much for all your insights today. Thank you in particular to our viewers who submitted questions. They really make Market Call happen. Thanks, Jaime. Have a good weekend.